Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is the Northbound Wealth Podcast and your host, Brent Foster. This is Weekly Market Insights. Here's the headline. Kevin Warsh nominated to Fed Chair. Today is February 2nd, 2026. With the first month down in this new year, things are really going. Stocks were mixed last week as investors navigated fourth quarter corporate results, a widely expected Fed decision, and a handful of economic reports. That's the headline. The Standard & Poor's S&P 500 index rose 0.34%, lifting the market benchmark's January gain to 1.4%. The S&P 500 ended Friday's session at 6,939.03, near but slightly below the record closing high it reached earlier this week at 6,978.60. So the index also posted a record intraday high this past week at 7,002.28. The NASDAQ Composite Index edged down 0.17%, closing Friday's session at 23,461.82. Dow Jones Industrial Average declined 0.42%, closing Friday's session at 48,892.47. By contrast, the MSCI EAFE Index, which tracks developed overseas stock markets, rose 1.22%. So, weekly market insights, the MSCI EAFE which is the developed overseas markets, foreign markets are leading the way. Year to date, trailing number up 5.05%, Dow Jones 2.17%, S&P 500's up 1.88%, and the NASDAQ's up 1.92% for the year to date. Now, over the last 1 year, trailing foreign markets up 32.54%, Dow Jones up 11.64%, S&P's up 16.88%, NASDAQ is up 21.43%. So still doing well on that 1 year and 5 year number, as well as year to date. Things have really done well, 1, 3, and 5 for a lot of the indices. 10-year Treasury note trading up slightly, 4.26%. Over the last month, that's up 2.90%. Over the last 3-month change, that's up 3.65%. But the 1 year change, it's down 5.75%. So we were at a print of 4.52%. So we're trading at 4.62 today. So down kind of in the middle of all of those ranges. All right, let's move on. S&P 500 touches 7,000. That's a big deal psychologically, I guess. The slim move came as investors parsed through quarterly earnings reports. Better than expected results were posted by companies including SanDisk and Visa, while Tractor Supply was one of those with weaker than forecasted reports. President Donald Trump chose Kevin Warsh, who served as governor on the central bank's board from 2006 to 2011, as head of the Federal Reserve. Before joining the Fed, Warsh was part of the George W. Bush White House and had worked at Morgan Stanley. It'll be interesting to see how his influence on the Fed board plays out this year, as it is a significant role, impacting how markets behave this year and beyond. It could be constructive for markets and the economy. I'll be watching the path of interest rates and policy closely. By sector, communication services had the largest percentage gain this week, climbing 4.2%, followed by a 3.9% increase in energy and a 1.7% advance in utilities. Consumer staples, financials, industrials, real estate, and financials also edged higher. Verizon Communications and AT&T led the gains in communication services as they reported fourth quarter adjusted earnings per share and revenue above analysts' expectations. Both companies also forecast 2026 adjusted EPS above analysts' mean estimates. EPS is earnings per share for those that don't know. Verizon's shares jumped 13% on the week as AT&T climbed 11%. The advance in energy sector came as crude oil futures reached a 4-month high this week amid geopolitical tensions. Chevron, Exxon were among the sector's best performers as both companies reported better than expected fourth quarter results amid higher oil output. Chevron's shares rose 6.1% on the week, while ExxonMobil added 4.8%. United Health Group, UNH, was among the healthcare sector's hardest hit stocks. In fact, I had to exit all those positions. I got stopped out, tumbling 19% amid mixed fourth quarter results. The company's earnings topped market expectations, but revenue fell short of estimates, and the health insurance company forecast 2026 revenue below analysts' expectations. And that is true with what looks like is to be less profit for those big players in the insurance space for healthcare. Gold and silver rally, pullback, and market signals. So gold and silver were back in focus this past week as a strong rally gave way to a sharp pullback. After reaching new highs on safe haven demand and geopolitical uncertainty, both metals sold off as profit-taking picked up. The U.S. dollar strengthened and policy expectations shifted. Gold fell more than 7% on the move, while silver saw one of its largest single-day declines in decades, highlighting how quickly positioning can unwind after an extended run. Even with the volatility, the broader case for the precious metals remains intact. Ongoing political and fiscal uncertainty, a still fragile confidence backdrop, and sustained investor demand continue to support longer-term interest. Near-term price action may remain choppy as markets digest policy signals and test technical levels, but gold and silver continue to reflect elevated macro uncertainty rather than a clear break in trend. That's key. There are investment banks with price targets of gold by year-end of 2026 reiterated at $6,300 per ounce and silver price target range of $70, $80 per ounce. The MOMO crowd, or the momentum crowd, was buying gold and silver, causing a melt up recently, and the sell pressure by institutions got to them. Unfortunately, many with margin calls are forced selling to cover margin requirements, selling of even unrelated quality holdings in their portfolios, which begot more forced selling for the MOMO crowd. The volatility in both gold and silver will eventually settle down and rebase to eventually move higher this year. So if one wants to, quote, buy the dip, end quote, in gold and silver, one would be wise to exercise caution, and lots of caution. I've got a chart out there on the blog. You guys can read this release, and as well as see the charts that I have posted. Chart of the week is the gold silver one. All right. So the Fed holds steady. So the Fed funds rate was held at its current 3.5% to 3.75% target range at its January meeting. The decision followed 3 consecutive meetings at which the Fed cut rates. It marked the first time the Fed held rates steady since July. The next Fed meeting is in mid-March. This week, key economic data. Let's see here. Monday, auto sales, Institute for Supply Management, ISM Manufacturing Index. Tuesday, the ISM Services Index, job openings for December. Okay, it's going to be reported. Wednesday, ADP employment report. Thursday, weekly jobless claims. Atlanta Fed President Raphael Bostic speaks. And then Friday, jobs report, consumer sentiment, and consumer credit report. So we'll be following that. Notable companies reporting earnings this week. Monday, which is today, Palantir, which I'm going to be watching closely, and the Walt Disney Company. Tuesday, Advanced Micro Devices, Merck, Pepsi, Amgen, Pfizer, and Chubb. They do insurance, by the way. Wednesday, Alphabet, which is Google. Eli Lilly and Company, AbbVie, Uber, Qualcomm, Boston Scientific, CME Group, and McKesson Corporation. Thursday, Amazon, ConocoPhillips, Bristol Myers Squibb, KKR, and Friday, Philip Morris. So it's going to be a fun week this week again. A lot of companies reporting. Okay, tax tip of the week. So know and understand your correct filing status. Taxpayers should understand their filing status well, and at least be familiar with other choices. When preparing and filing a tax return, the filing status affects if the taxpayer is required to file a federal tax return, if their standard deduction, what their standard deduction amount is, if they can claim certain credits, and the amount of tax they should pay. Here are the 5 filing statuses. So, for those who don't know, there's single. This status is normally for taxpayers who are unmarried, divorced, or legally separated under a divorce or separate maintenance decree governed by state law. 2, married filing jointly. If a taxpayer is married, they can file a joint tax return with their spouse. When a spouse passes away, the widowed spouse can usually file a joint return for that year. 3, married filing separately. So married couples can choose to file separate tax returns in certain circumstances. 4, head of household. Unmarried taxpayers may be able to use this filing status, but special rules apply. 5, qualifying widow or widower with dependent child. This status may apply to a taxpayer if their spouse died during one of the previous 2 years and they have a dependent child. Other conditions also apply. So, those are the 5 statuses. This information is not a substitute for individualized tax advice. Please discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the next segment. Hey, I just want to cover a little update in real estate. The housing market is swinging towards buyers. Nearly 2/3 of home buyers last year purchased at discount to original listing price. That's the highest proportion since 2019. This was an article in the Wall Street Journal by Nicole Friedman and updated February 2nd. So the share of homes that sold above, at, or below their original list price, it looks like things are moving in the direction of buyers. Many home shoppers have given up on the depressed housing market where sales are stuck at 30-year low, but those buying are enjoying discounts at the highest rate in years. About 62% of buyers last year purchased a home below the original listing price. That was the highest proportion since 2019, according to a new analysis by the real estate brokerage Redfin. The average discount for the homes that sold below their original listing price was around 8%, the largest since 2012. So buyers are also obtaining concessions from sellers, including cash that can be used for closing costs or to buy down a buyer's mortgage rate. The proliferation of discounts and incentives offer the latest evidence that the housing market is tilting back in the buyer's favor. From 2020 to 2022, it was a robust seller's market as rock bottom mortgage rates attracted hordes of buyers. Cutthroat bidding wars were routine, and buyers went to great lengths to ingratiate themselves with sellers. Now the situation has flipped. The housing market had over 600,000 more sellers than buyers in December, the biggest such gap on record in seasonally adjusted data going back to 2013, according to Redfin. Many would-be buyers are sidelined by high home prices and elevated mortgage rates, and home buying demand is low. For those who are still able to buy, they have more homes on the market from which to choose and more power to negotiate. Quote, when there is a gap between what sellers expect and what buyers can afford, it's the buyers that end up negotiating that lower price, end quote, said Daryl Fairweather, Redfin's chief economist. Sellers aren't the ones that dictate prices, it's buyers that do. Fairweather says she expects a small increase in home sales this year after sales of previously owned homes held last year at the lowest level since 1995, so the 1900s. Buyers and sellers are going to be more on the same page about what an appropriate price will be, Fairweather said. Market gained some momentum in recent months. Mortgage rates are lower than they were a year ago, making purchases more affordable. Sales of existing homes jumped 5.1% in December, the biggest gain in nearly 2 years, while home price growth slowed. The market is the most buyer-friendly in southern markets, especially Florida and Texas, where new home construction in recent years contributed to a bigger supply of homes for sale. In the Florida metro areas of West Palm Beach, Fort Lauderdale, and Miami, at least 85% of homebuyers in 2025 paid under the original listing price, according to Redfin. Buyers were the least likely to get a discount in Newark, New Jersey, where 32% paid under the original listing price, followed by San Francisco and San Jose, California, both at 39%. New construction in those markets has been limited. Because home purchases are so expensive, buyers are being picky. even in cities where the inventory is lower than normal. Homes that are priced too high can sit on the market, according to real estate agents. Sellers think that we're living in a 2021 world where you could overprice your home and still get multiple offers. That's just not happening now, said Jocelyn McAlhison, a real estate agent in Waltham, Massachusetts. Homes that need renovation are sitting because buyers are hesitant to take on potentially costly projects, according to agents. The number of home purchase contracts being canceled has increased, partly because of buyers who back out of deals after inspections. There's definitely sellers who are willing to negotiate way more now than they were the last couple of years, said Jason Moon, a real estate agent in northwestern Indiana. John and Hannah Vocal started house hunting in the Austin, Texas area in 2024, but they thought homes were overpriced at the time. Since then, the general lowering of buyer demand has made the market a good bit more favorable, John Vocal said. This is the best environment that I think I've been in as a buyer so far, end quote. In January, they had an offer accepted for a 3-bedroom home for 4% below the listing price. We were super excited, he said. So there you go. Take a look at the markets around there across the country and you'll get a feel for it. But hopefully this information has been helpful. Write to Nicole Friedman at nicole.friedman@wsj.com if you have questions about that or her article. It's very good, I thought. All right, on to the next segment. This is an article, February 1st. AI's fundraising frenzy continues. Plus, an impressive EV from China. 7 reasons teens say no to AI. Trouble with the NVIDIA OpenAI mega deal and how AI is coming for Apple's profit margins. In this edition of the Technology Newsletter by Kate Clark of the Wall Street Journal, there was once a time when reaching a $1 billion valuation felt rare. In the age of AI, companies are hitting that milestone on a weekly basis. It goes something like this. A star researcher leaves OpenAI, Meta, or a university lab says they want to explore a new idea. Suddenly, venture capitalists are wiring boatloads of money. Wrote about this trend this week. A new and growing crop of neo labs, research-first startups focused on long-term science instead of short-term profits, is raising billions of dollars despite having no products, no revenue, and no plans to pursue them anytime soon. Investors are convinced these small startups could become the next OpenAI or Anthropic. Speaking of OpenAI, a clearer picture emerged this week of just about how the ChatGPT developer would meet its ambitious $100 billion fundraising goal. We reported that SoftBank is discussing another $30 billion investment in the company, adding to the already massive amount of money it's put into the company. We then reported that Amazon is weighing an investment of up to $50 billion in OpenAI. This might be this might be its last go at private financing before a fourth quarter initial public offering or an IPO. An IPO by the year's end could be tricky for the startup, but pressure is mounting for it to get out the door before Anthropic beats it to public markets. Again, here's the latest from other columnists. So Joanna Stern test drove a Chinese EV. Now I don't want to buy American cars anymore. Okay, I fell for the Xiaomi SU7 Max inside and out, and now I left wanting what I can't have, at least for now. There are growing signs Americans might not have to wait forever to experience China's superior take on the EV or electric vehicle. Okay, so NVIDIA, the $100 billion mega deal between OpenAI and NVIDIA is on ice. NVIDIA's plan to invest up to $100 billion in OpenAI to help it train and run its latest artificial intelligence models has stalled. The two sides are rethinking the future of their partnership. And the latest discussions include an equity investment of tens of billions of dollars as part of OpenAI's current funding rounds. People familiar with the matter said. How AI stole Tim Cook's negotiating power. Apple has dominated the electronic supply chain for years. No more. Artificial intelligence companies are writing huge checks for chips, memory, specialized glass, fiber, and more. And they have begun to outduel Apple in the race to secure components. Apple's profit margins will face pressure this year, analysts say, and consumers could eventually feel the hit. Fiber fitters. The rush to lay cable for the AI boom is hitting a human bottleneck. Crews can't hire fast enough. When they do, workers are often poached by competitors. Bye-bye baddies. Google has aimed a knockout blow at a massive cyber weapon that researchers say is running silently on millions of devices in homes of consumers. Make AI not war. Anthropic and the Defense Department are at odds over how the AI startup technology can be used, tension that could lead to the cancellation of its contract. X on X, Elon Musk's rocket maker SpaceX and artificial intelligence startup XAI are planning to merge, further consolidating the billionaire's business empire and setting the stage, what I might add, for a super IPO maybe this year. The technology newsletter for the Wall Street Journal is a weekly digest of tech reviews, columns, and headlines from Deputy Tech and Media Editor Wilson Rothman and Deputy Tech Bureau Chief Brad Olson. You can write those guys. You can check them out online, but I definitely subscribe to the Wall Street Journal and love learning more about what is happening in the tech space and on the AI front. Stay tuned for the next segment. All right, so let's check this out. Let's talk about the S&P 500. And what I have is a daily chart. The range is a year, and I've got multiple studies, the RSI, the MACD, the full stochastics, the advanced decline lines, the 50-day moving average, the 200-day moving average, price overlaid, got volume all in there. So I'm able to see what's going on. And it's just a 1-year chart. And I look back, and it has been a long time since April of 2025 when we had that tariff fear spike that happened when Trump started going off on tariffs. And we literally fell from between a range of 6,100 and 6,200 on the S&P. Today, we're trading at 6,984. So, yes, we're trading up above that, but not like substantially. What's crazy is from that high in late February, mid to late February, there was a sell-off in 2025 that was drastic. We went from that range of 6,100 to 6,200 all the way down to below intraday, below 4,900, if you can think about it. It's like 4,700 or so. It was a big drop. And it was an ABC correction. It was a quick, I say correction, but some people call it a bear market. I would say it pretty much was. It was a 20% decline from there. And it ends up being a quick bear market. Then we're off to the races. If you want to look at it that way, there's other ways to look at it as just a correction within a much bigger super cycle that's going to last to like 2030 or maybe even beyond. We don't know. We gotta check it out. But here's where it's at. Like the 50-day moving average crossed over the 200-day at that time. There was severe technical damage done. And then on, I think it was April 9th, Trump tweeted and said it'd be a great time to buy the market. And of course, there was a rollback of a lot of those tariffs that he implemented. And, Scott Bessent talked some sense into him as to like, this isn't the way to go about this. And then it was off to the races. We absolutely ripped out of there all the way from like the 4,700 all the way up to, what was that? 59 to 6,000 or so. And then we broke through and broke out of that and been trading well above the 50-day for quite a while and bouncing off of it from April all the way to, let's say, October, November of 2025. So that would be last fall. And then we broke through that 50-day temporarily at the end of November, and we had an ABC correction within that particular impulse wave. And then at the end of November, it was over. It was done. We ripped back up higher from 6,600 range to 6,985 to 7,000 intraday recently. And so if you compare 6,985 where we're trading today on the S&P 500 back to April 9th of 2025, like that 4,800 range, that is a couple thousand points. So that's a huge move over the course of not even a year. So there's a lot that can happen in these markets. There's a lot that can spook the markets. And I think the passing the OBBBA was really solid. I think that's going to help a lot of the mid-sized, smaller companies and big ones continue to do well. But the AI boom and it is still there. Technology is still leading. They're making a lot of money. It's helping the rest of the economy, and we'll see how this plays out. There's always going to be corrections. There's a lot of data to support this, but S&P 500 usually has an intra-year correction on average over the last 47 years, 45 years of 14.7% intra-year declines relative to S&P 500. Like that's a calendar year. So get used to having these shocks that happen or corrections that happen because they are actually normal. So it's not a time to panic. It's just understand where you're at on the in your life, where they're in accumulation stage, or you're getting close to retirement and distribution stage, trying to generate a lot of income. Kind of know where you're at and save and invest. Always have that discipline, even if you're young and in your 20s, and then even when you're in your 50s and 60s. That's a great time to catch up. It's a great time to allocate to quality instruments or quality companies that are going to continue to produce, whether it's growth or income, and diversify your portfolio to a degree that is acceptable to you. Owning different companies in different industries, different names, not just being 100% focused in one sector, i.e., technology. Because if it has a substantial or protracted downturn, that could really hurt you unless you have the stomach or the gut for it or the understanding to be able to not sell during a downturn, but actually add capital or add cash to buy it. That's most asset allocators and wealth managers are going to say, yeah, let's diversify. Smart investing would be wise investing is not all your eggs in one basket, but diversify across many asset classes so that not one of them takes you out. That is a very important discipline to have. But as far as the S&P 500 is concerned, steady as she goes, kind of trading within range. Earnings look good. Companies are reporting decent earnings guidance. Things are moving along. So I don't expect anything outside, obviously by definition, outside the ordinary correction. But that's the romance of the markets. You can always have something happen like a black swan. That's something that I talk to clients about a lot is, we could have a global war. We could have something that we don't see. And obviously by definition, it is that. So we just try to hedge those risks out and go over financial plans, go over budgets, make sure that assets are being invested appropriately and concentration is addressed and risk is addressed, volatility is addressed, all those things. So if you don't have somebody and you don't really know what to do and where to go and how to navigate these markets, navigate your finances, decisions to make, whether that's where to invest, how to save, how much I should, do I have enough? Am I going to get there? Am I too risky? Am I too conservative? Actually leaving a lot of money on the table. Some people get stuck in their own way and they can't decide. So they sit in cash and then they miss out on gains. They miss out on creating more and more wealth by having the markets work for you instead of sitting there in cash, doing nothing. So there's ways, even if you got money sitting at a bank and banks aren't paying you interest, they should be paying you an inflation rate, but they don't because they don't have to. And so it's up to you to say, where could my money be working better for me? And how should I be investing? And that's talking to a financial professional, whether it's Northbound or somebody else. Get involved and take some ownership. Just like in healthcare, you got to take ownership of your own health and in your own investing in order to hit your goals or achieve what you want to achieve in life. So, there's some food for thought in the technical analysis spotlight. I'm watching it. We're trading above the 50-day. Hopefully the market continues to broaden out, not just the Mag 7, but the other 493 that are in the S&P 500. Also, international is doing quite well given the environment. So not bad. There's opportunities out there, and I'm excited for this year in 2026. So thanks for listening in. Thanks for tuning into the Northbound Wealth Podcast. Hope you found it helpful, and we'll talk to you soon. Have a good week and weekend.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.